Hi, my name is Will from KOSEC, Kodari Securities, and in this presentation we're going to be going through why taking a macroeconomic approach could potentially help you make better and more logical investment decisions. Now, essentially, there are far more influences on stock prices than company earning reports, and a smart investor knows to keep an eye on all key economic indicators that can signal a change in the markets.
As always, any information given is general in nature and does not take into account your personal needs or objectives. Now, for further information, visit our website, www.kosec.com.au. So let's take a look at what we're going to discuss today. So first and foremost, we're going to go through what is macroeconomics. Then we're going to look at what the main factors of macroeconomics are. Then what we're going to do is we're going to look at macroeconomics versus microeconomics and what the difference between those two are. Then what we're going to do is go into what other macroeconomic factors we need to consider as investors. And then finally, we're going to look at how macroeconomic factors affect the stock market. So why does the price of a product you want to buy go up and down? Is there a greater demand for that product than there is a supply of that product? Does the cost go up because of raw materials that are needed to make it? Are they getting more expensive? Or is it something like a war in an unknown country that affects the price? To answer these questions, we need to turn to macroeconomics. Some of the key questions addressed by macroeconomics include what creates or stimulates economic growth, what causes unemployment, and what causes inflation. It attempts to measure how well an economy is performing, to understand what forces drive it, and to project how performance can improve. Macroeconomics is difficult to teach, partly because its theorists disagree so much about it. It's a very complicated subject with many factors that influence it. These factors are analyzed with various economic indicators that tell us about the overall health of the economy. Things like looking at variables like unemployment, GDP, and inflation, which we're actually going to go through in more detail later in the presentation. From these factors, macroeconomists construct models to explain the relationship between the factors that influence it. These models are used by government entities to aid in the construction and evaluation of economic, monetary, and fiscal policies, businesses to set strategies in the domestic and global markets in order to determine whether expanding production will be welcome to the market, and finally by investors to predict and plan for movements in various asset classes. As previously stated, macroeconomics broadly focuses on national output, unemployment, and inflation. Let's take a look at national output. The national output of a country is measured by its GDP, or gross domestic product. GDP, or output, refers to the total amount of goods and services a country produces. This measure provides a snapshot of an economy at a certain point of time. It is a stepping stone into macroeconomic analysis, and based on what analysts learned from the past, through looking at an economy's GDP, they can then begin to forecast the future state of the economy. However, it's important to remember that what determines human behavior and ultimately the economy can never be forecasted completely. Let's take a look at the unemployment rate. The unemployment rate is a measure of how many people from the labor force are unable to find jobs. When an economy grows, which is indicated by the GDP as we discussed before, unemployment levels tend to be quite low. This is because when GDP increases, an economy's output is higher. Therefore, more workers are needed to keep up with the elevated production levels. Lastly, let's look at the inflation rate. Inflation rate, this is the rate at which prices for goods and services rise. The most common indicator of inflation that macroeconomists look at is the Consumer Price Index, or CPI. The CPI gives an indication of the current price of the selected baskets of consumer goods and services and measure the average change in the price over time. Something to note is that there are two sides to the study of economics, macroeconomics and microeconomics. As previously stated, macroeconomics is the study of the behavior of the economy as a whole. This is very different from microeconomics, which tends to concentrate more on individuals and how they make their economic decisions. It looks at economic tendencies and what can happen when individuals make certain choices. These individuals are typically classified into subgroups such as buyers, sellers, and business owners. And while microeconomics looks at single factors that affect individual decisions, macroeconomics studies general economic factors. However, factors studied in both microeconomics and macroeconomics typically have influence on one another. For example, the unemployment level of the economy influences the supply of workers from which a company can hire. Now, something to keep in mind is that what ultimately determines output is demand. Now, demand primarily comes from three entities, which are the consumer, for investment or savings, residential or business-related purposes, the government, spending on goods and services for federal employees, and import and exports. Now, demand will determine production levels or supply, and these two factors will interact and determine the price of goods. The law of supply and demand is one of the most basic economic laws, and it ties into almost all economic principles in some way. In order to feed demand and supply, money is needed, and a country's central bank, the Federal Reserve over in the US, typically puts money in circulation in the economy. The sum of all individual demand determines how much money is needed in the economy, and to determine this, economists refer to GDP, which measures the aggregate level of transactions, so that they can determine the suitable level of money supply. Two other macroeconomic factors to keep an eye out for are business confidence and consumer confidence. Business confidence, which is domestically displayed via the NAB's Business Confidence Index, is a key measure of business conditions in a country, and it's published monthly and quarterly. Changes in business sentiments can be early signals for future economic activity, such as spending, hiring, and investment. A NAB business confidence reading above 0 reflects improving business conditions, and below 0 reflects falling business conditions. Now, consumer spending is key to any economy, and a number that expresses consumers' feelings about the economy and their personal financial situation is consumer confidence, or the Consumer Confidence Index, CCI. It is defined as the degree of optimism about the state of the economy that consumers are expressing through their spending and saving, and it is recognized by the Organization for Economic Cooperation and Development as a leading indicator for the US economy. Consumer confidence usually increases when the economy expands and decreases when the economy contracts. However, since consumers may not have a perfect information source, and it may take several months to notice and feel the effects of changes in economic activity, the measure is considered a lagging indicator of the stock market's performance. Now let's take a look at how some of these factors could potentially influence the stock market. We'll start with the big one, being GDP. Since this is the most comprehensive indicator, naturally it will have an impact on the stock market. This is because a stock's price reflects the expectations of future performance and profitability of a company. Therefore, if a company is operating in a healthy economy that is growing, it is more likely to report better performance across its profitability measures. Like GDP, the unemployment rate reflects weakness and strength in the economy. Investors tend to follow this number quite closely because more people with jobs tends to equate to higher economic output and corporate profits. Now, just like unemployment rate, inflation is also a measure that is watched closely by investors, since a rise in prices could possibly dampen consumer spending. As mentioned previously, consumer spending is key to any economy. It can make up 2/3 of GDP, and it causes central banks to raise and drop interest rates.
So in this presentation, we covered the basics about macroeconomics. We also went through the main macroeconomic factors and how it influences the stock market. I hope you found it helpful. This presentation has been brought to you by KOSEC, Kodari Securities. Thank you, and have a nice day.